Daniel LeBeau. Welcome back to the Fourth Revolution, where we discuss stocks for your portfolio of the future. And those stocks for the future are looking pretty overbought right now, and it may be prudent to put on a hedge position going into this uncertain earnings season. And we're already seeing this buy the rumor, sell the news price action come out as Q2 earnings season commences, and we're seeing it in big banks. At Goldman Sachs, JP Morgan come out with earnings yesterday that were unbelievable beats. But the markets were still willing to pull profits. They priced these stocks all the way up into earnings to get to these numbers, and once they saw them, they were out. And we can see the same thing going into these big tech earnings as the NASDAQ 100 hits a new high seemingly every single day, and we're in pretty overbought territory as far as the NASDAQ 100 goes, with its four biggest holdings all sitting in some of the highest RSI levels that we've seen since last September. And you remember last September we had a big pullback in this NASDAQ 100, and it could be a savvy move to protect yourself against a potential pullback at these lofty levels. So let's take a look at the charts and see where we're sitting and see what kind of options we can put on to protect ourselves against this potential downside. This is Apple on tradingview.com, and you can just see this precipitous rally we've had since the beginning of June, all the way up over 20% in a month and a half, driving this RSI level to its highest level since last September. And we all know what happened last September. We had a pretty sizable sell-off. And once we get deep in these RSI territories, the selling pressure can be pretty prolific. And like I said, we saw that last September, and we can continue to see that in this uncertain market today. You can see this again. Microsoft, similar story. Haven't seen these kinds of levels since even before the pandemic. It looks like Google, same thing. Overbought RSI levels. Apple makes up over 11% of the NASDAQ 100. Microsoft makes up about 10% of the NASDAQ 100. Google makes up about 8% of it. So these are all sizable portions of this NASDAQ 100. And this is QQQ. This is the NASDAQ 100 conduit, the ETF that tracks it. And you can see that this entire index is at the most overbought levels that it has been since, like I said, last September, when we had this huge sell-off of more than 10%. And right now, we're seeing pretty cheap options with the VIX sitting at about 16. This is sizably below anywhere we've seen the VIX be in the pandemic times. So the implied volatility on these options is low, which means the options are relatively cheap. So I am looking at August 20th expiring options, and I am focusing on 355 strike price at these August 20th expirations. I'm looking at August 20th specifically because that is the monthly date, and those are going to be the most liquid put options that you can buy. So let me specify. I'm looking at August 20th strike price of 355 put options. So let's dive into how many options you should buy based off your portfolio size. So when looking to hedge your portfolio with options, the first thing you want to consider is what ETF is best for me. And I look at QQQ because I'm pretty heavily weighted in tech, and obviously QQQ, the NASDAQ 100 is the tech index. And if you're more broadly based, you got a healthy allocation across the board between value, cyclical, and growth. I would take a look at SPY, which is the S&P 500 ETF. And then just going through, trying to figure out how many options you want to buy, how many puts you want to buy to fully hedge your portfolio. And this is academic. You don't want to fully hedge your portfolio. But just to explain how to do it, you take the delta of that option, and it's going to be negative. So you want the absolute value of that delta, because put options delta are negative because it's inversely correlated with the stock. So you take the delta, which is the speed at which that option moves with the underlying price of the stock, which is 100 shares of whatever you're looking at. And you take that delta, you multiply it by 100 shares because it's how many shares are in each contract. And then you multiply that by the price at which that ETF is trading. And then you take that value and you divide it, or you divide your portfolio by that value. So explain it again. Up here, you have your portfolio's value. Down here, you have delta times 100 times the value of the ETF. And that's how you get how many shares, or how many, should I say, put options you want to fully hedge your portfolio. And you don't want to fully hedge your portfolio. You want to take about half the number of shares that you get from that calculation to hedge in this uncertain environment. So you still have that upside potential, but you are hedging yourself against any sizable downside move. So that would be the best option going forward here. And like I said, I'm looking at the August 20th, because those are the monthlies. Those are the monthly options with the most liquidity. August 20th expiration with a strike price of 355 for the QQQ. And obviously, if you're looking at SPYs, look at August 20th as well, because like I said, the most liquid contracts will be under that expiration. So don't forget to check out Zacks.com/promo, where we have an opportunity to take a look at Counterstrike, which is Jeremy Mullen's portfolio that attacks companies that are on the slide that have some upside potential moving forward. So don't forget to check that out, and look forward to seeing you guys next time.